Hello everyone, a very warm welcome to those that have joined the webinar already, but we are expecting quite a number more of attendees today from several countries. So whilst we wait for others to join, I'll just run through a few housekeeping items before we kick things off. So to start with, you'll notice that your lines are muted and that your cameras are turned off. Ours will be turned off shortly during the presentation just to minimize any technical disruptions and to allow you as the audience to focus on the presentation slides. On screen as well, you'll notice that you have a control panel and you can submit any questions in there that you might have, and we'll get through as many of them in the Q&A section at the end. So with that, I see the attendee numbers are ticking up. So in the interest of respecting your time, I'll make a start. Hopefully, most of you know by now that this webinar today is part of Convera's monthly webinar series to help organisations like yours keep abreast of the key themes that and trends that are driving global financial markets. For example, last month we focused on the turmoil in the banking sector, and that has to some degree eased, but it certainly hasn't vanished. You know, the collapse of First Republic Bank over the weekend and regional banking shares plunging over the last couple of days. This theme is certainly one to be aware of. But for today's webinar, we're bringing the focus back to monetary policy, given we've got the US Federal Reserve's decision in a few hours' time and the European Central Bank's decision tomorrow and the Bank of England next week. Last month as well, overall April was a relatively calm month for financial markets with low levels of volatility across the board and range-bound trading in currency markets. So will these upcoming policy decisions inject some life back into markets and prove inflection points for particular currency pairs? Or currencies are driven by interest rates primarily, but what is driving interest rates is highly important, and the future path of these decisions by central bankers will depend on the evolution of data on growth and inflation, as well as the banking sector stress. So this is what we'll be covering in greater detail today in a more holistic global overview from different perspectives around the world. As you can see, our speakers include myself. I'm George, UK macro and FX strategist. I'll be facilitating today's webinar and covering the UK European currency section. And we have Stephen Dooley in the middle, our macro and FX strategist from Australia. He'll be presenting the macro segment. And then we've got Joe Menimbo on the right there, our FX specialist from the US, providing some important insight on the US and Canadian situation. In terms of the agenda, it's pretty straightforward. I'll hand over to Steve shortly for an overview of the global economic outlook, the key themes influencing market sentiment, and the key events to be aware of for the month ahead. Steve will pass back to me for the UK and the European currency section and forecast scenarios. And then I'll hand over to Joe for his standpoint on the US before we then finish off with the Q&A. So let's get into the main presentation. We'll switch off our cameras now just to allow you to focus on the data and the supporting visuals, as I mentioned at the start. Remember, any questions that you have, just use the control panel to submit. So before I pass over to Steve, I just want to call out some of the key insights from our research here to cut through some of the noise and distinguish the important takeaways that businesses like yours should be aware of. Firstly, the US dollar remained under pressure last month because of the banking fears subsiding, a low volatility environment that we witnessed that boosted demand for riskier assets and hurting the safe haven dollar. And both the pound and the euro capitalized, climbing to near one-year highs versus the dollar as a result of this. But it's also because they were supported by expectations of higher interest rate rises or more interest rate hikes by the ECB and the Bank of England, outnumbering the number of hikes for the Fed expected for the remainder of this year. Are we going to see a continuation of these trends if the Fed signals a bias towards pausing from raising interest rates even higher? Or could we see a reversal of these trends to levels back to pre-banking crisis levels if the Fed reinforces its battle to bring inflation back to target with more rate hikes than the market is currently pricing in? As I mentioned before, the future path of monetary policy will depend on the evolution of the data and growth on inflation. So with that, I'll hand the reins over to Steve to walk through an update on the latest economic data and how the current climate might influence upcoming central bank decisions. Over to you, Steve.
Thank you very much, George, and very grateful to be here today. It's been a fascinating start to the year because, of course, we've had so many major events already in the first 4 months of the year. We've had concerns about recession. We've had inflation that's remained higher and more persistent. We've seen a pickup in expectations for interest rates around the world. We've had multiple banking crises, and we've had ongoing geopolitical tension. But what's been interesting is that volatility, maybe not in bond markets, but in equity markets and in FX, has been remarkably low. So we enter May with a series of contradictions where inflation remains higher than forecasts were at the start of the year. Economic data, despite rate hikes, economic data has remained more resilient, and financial markets, particularly FX markets, have been remarkably quiet. So let's drill down a little bit further into those three themes and think about how they contradict each other and work out how this potential contradiction could eventually resolve itself. But clearly, the biggest factor for central banks, and certainly in Australia, we've seen this over the last 48 hours, is that while inflation has come down by some measures, by other measures, it's remaining remarkably resilient, persistent, and to use the phrase beloved of economists, sticky. And so in this first panel here, you can see the black line, goods inflation. And of course, what drove a lot of inflation over the last 2 or 3 years has been that massive demand for goods, for new computer monitors, for exercise equipment, for Nintendo Switches during those lockdown periods of the pandemic. That's very much resolved itself. There are only so many Nintendo Switches, exercise bikes, and computer monitors you can buy. So goods inflation has come off quickly. That's dragged down headline inflation in purple. But what's starting to become apparent is that services inflation and core inflation, which core inflation that removes some of the more volatile components of inflation, core inflation and services inflation has remained persistent. And as I said, in Australia, we've seen that in the last 48 hours with the Reserve Bank of Australia surprising markets after only going on hold last month, reversing course and saying that they needed to hike rates again at their May meeting. So this is certainly what we're seeing. It's very apparent throughout Europe with the European Central Bank, the Bank of England and the Swiss National Bank seen as needing to hike rates further to try and control inflation. But one of the main themes that we are seeing is that inflation is remaining more persistent, particularly in the core and those services components. And in fact, if you look at those core and services components, they haven't really budged over the last 12 months. And we've seen that in Europe, we've seen that in the US, and we've seen that in the UK. So this is one of the key themes, because while the headline numbers have come off a lot, if core numbers remain persistent, then that might cause central banks around the world to continue to hike rates. Now, central banks around the world have already hiked rates by the largest amount that we've seen, certainly in the modern environment of monetary policy over the last 60 years. But what's been really surprising is that the economic data, not just inflation, but the activity data as well, has remained remarkably resilient. And if we look at the PMI numbers, not so much in manufacturing, because as we already mentioned, a lot of manufactured goods are not in demand the way they were 12 or 24 months ago. But if we look at activity data, services data, it's remained remarkably resilient. And that's particularly we've seen from the measure of economic surprises from Citigroup, which has recently reached 2-year highs both in Europe and in the US. Now, this is incredible after so many interest rate hikes around the world. So again, this is another theme that ties in. Inflation's remained higher and more persistent. Economic data has remained stronger and more resilient. And that's all occurred in a period where FX markets and equity markets as well have been more calm than certainly we would have expected when we consider all of these events that have been thrown at financial markets over the first 4 months of this year. It can be seen from the VIX, the so-called fear gauge in US equities, which is at its lowest level since 2021. You can see here with global FX volatility, lowest since February 2022. As we mentioned, bond markets have been a little bit different. They've been elevated, but in FX and equity markets, markets have been surprisingly quiet, and that's flowed through to their performance. US shares, they've come off over the last couple of days, but they remain near 8-month highs, and of course they rallied more than 20% throughout the back half of or the last quarter of 2022 and the start of 2023. So inflation remains more troublesome, economic data remains stronger, and markets remain remarkably calm. So one of these factors will have to resolve itself. Either inflation's going to have to drift back lower, economic data is going to need to slow, or financial markets are going to need to pick up in volatility. Otherwise, there's no reason to think that central banks will do anything but continue to hike rates further. So there's that uncertainty that we're waiting to see how this story plays out, and that's going to be the key theme, I think, over the next few months. Does inflation pull back from these persistent levels? Does economic data ease? And if those two factors don't occur, then central banks might need to raise rates further. And if they do, this quieter FX environment is unlikely to remain in place. So if we move on to the next slide, we'll look a little bit further about what might be the eventual trigger to jolt markets out of their current quieter period. And currently in FX markets, the key theme is this divergence in rate paths. Certainly in the US, the financial markets believe that if we do get a rate hike today, that's likely to be the final in the Federal Reserve's move. And in fact, financial markets are looking for at least 2 rate cuts from the Federal Reserve over the back half of this year. As we said, this seems unlikely if current conditions persist. If inflation remains high and economic data remains strong, then it's hard to see how the Federal Reserve would decide to cut rates twice. So that's a big uncertainty out there in markets. Are markets wrong on these US rate cut bets, or are we going to see a collapse in economic data? They're the 2 factors that we'll need to be watching over the next few months. Now, while financial markets think the Federal Reserve will cut rates in the back half of this year, they don't believe that in Europe, and they don't believe that in the UK. In Europe, they're looking for at least 3 more rate hikes in the foreseeable future. In the UK, it was up until recently also looking for 3 rate hikes. That's eased off a little bit. But this divergence in rate paths is the big driver in financial markets, in FX markets. That's what's caused the US dollar to drift sharply lower over the last 4 or 5 months, really since meeting its peak in October of last year. And it's what's caused the British pound to strengthen so much up around 125 versus the US dollar, and it's what's caused the euro to strengthen so much, up around 110 versus the US dollar as well. So this divergence in rate paths is really the big driver, and over the next 24 hours, we're going to see further evidence about whether that expectations, whether that divergence, whether the impact on markets is in fact warranted. So let's look at the path of what's coming up over the next month, and you can see that it's really rate decisions that are driving the FX calendar in May. In particular, of course, the Federal Reserve at 7 p.m. Tonight, British summertime, and then, of course, tomorrow, the European Central Bank. And really, for the current makeup of FX markets, with the US dollar near 12-month lows, with the euro near 12-month highs, for that makeup to remain, we're going to need to see the Federal Reserve at least signal that they are nearing a pause, that they're at a pause, that they're not focused on raising rates in the very near term, and we'll need to see the European Central Bank signal that they are expecting to raise rates further. This story is going to continue to develop. This divergence story is going to continue to develop as we look into next week on the 11th with the Bank of England decision. And of course, it's also going to be driven by inflation numbers that come out over the next few weeks as well. US inflation on the 10th and the UK inflation out on the 24th, and towards the end of the month, the European inflation figures, the final figures that we'll get towards the end of the month. So certainly for the moment, there are a lot of background stories, the debt ceiling, the US banking sector, but for now in FX, it's central banks, inflation, and how central banks react to inflation that's going to be the driver. Just to finish off on this last slide, I just want to look at the key event. And of course, no surprise, it's the Federal Reserve. And as we said, will they pause at the end of, will they signal a pause after this May rate hike? That, as I say, the market currently sees, you can see here, as a 93% chance. What's interesting is how much these expectations have changed over the last 2 months. You can see that certainly for most of February, a 25 basis point hike was seen as most likely. Towards the end of February, became more and more likely we'd need to get a 50 basis point hike at this meeting. We had the Silicon Valley Bank crisis hit, and then it suddenly shifted into the expectations of no change. And now, as we go into this meeting, a 25 basis point hike is seen as most likely. But again, the recent concerns over the last 2 days with some regional banks has meant that it might be a little bit more uncertain. What this shows is that markets have moved wildly in their expectations of what is going to happen, and that really illustrates just how uncertain that outlook is over the next few months. Yes, the current view is that the Fed will pause, will hike tonight and then pause. The current view is that the European Central Bank will continue to tighten and raise rates 3 times. The Bank of England is likely to follow suit. But looking at the last 2 months, how expectations have changed so much really illustrates the fact that, in fact, markets, central banks are reacting very, very quickly to the data, and that's creating a lot more uncertainty. It hasn't necessarily generated volatility over the last couple of months, but that's not to say that we can't see a big step up in volatility depending how markets react to these shifting expectations from central banks. So with that, how is it going to impact on individual currency markets? I'll pass back to George, and he'll have a look at how that's likely to impact in particular in the UK. George.
Excellent. Thanks a lot, Steve. Great comprehensive overview there. Plenty of valuable insight to help us prepare for the looming central bank decisions. I guess from my perspective, it could be argued that the hawkish expectations on the ECB and BOE tightening compared to the more dovish expectations for the Fed perhaps suggest a balance of risk for the euro and the pound are slightly tilted to the downside, whereas for the dollar, the risk could be tilted to the upside, just purely based on how the markets are positioned leading into these key events. But my job now is to use this information, analyze how currency markets have evolved over the past few months and what might unfold in the future using scenario-based analysis. So firstly, let's look at some of the recent volatility witnessed in sterling-denominated currency pairs. So this table here on the left-hand side provides the 30-day and the year-to-date highs and lows, the size of the trading range during these timeframes, and the position of the currency pair within these ranges. And I've highlighted the pound versus the dollar and versus the euro purely because they're the most traded or most commonly traded in the UK. But before discussing them, as you can see from the title, I wanted to call out the fact that the Swiss franc remains the best performing currency of 2023 so far. Hence, the pound to franc exchange rate is in the bottom 6% of its 30-day range and the bottom 20% of its year-to-date range. And that's mainly because of the franc's status as a safe haven currency backed by large reserves of gold, bonds, and financial assets to ensure its stability during times of volatility, but also because Switzerland has been less exposed to the energy crisis and headline inflation in Switzerland is already less than 3%. If you compare that to the UK, inflation still above 10%. It has been for 7 months now. You've got food and beverage prices some 20% higher than a year ago, and water, electricity, and gas prices more than 25% higher. All this is putting more pressure on the Bank of England to continue raising interest rates, and we expect another rate rise by the Bank of England next Thursday, as Steve mentioned, taking rates to 4.5%. But markets are pricing in further rate hikes to potentially 5% a peak by the end of this year, meaning a couple more hikes after next week's is anticipated. And this is arguably one reason for the pound's recent strength, because Economics 101 implies that rising interest rates should result in the strengthening currency. It's not always as simple as that though, because it does depend on what's driving interest rates higher. And we discussed that in detail in our webinar in March. Ultimately, when inflation remains elevated whilst an economy is slowing or recession is pending, this is anything but positive for an economy or a currency. And if you look to the bottom right chart where the bars are, this is why I've called out the fact that the sterling dollar exchange rate is mostly falling in the days after the Bank of England rate hikes since it started hiking in late 2021. But we have seen a bit of a turnaround over the past month. The pound's correlation with rate expectations has actually strengthened in a positive way. And I think this has something to do with the fact that the economic data in the UK has surprised higher recently. We've seen accelerating wage growth, retail sales beating forecasts, private sector output growing at its fastest rate in a year or so. A lot of this is services based driven. So simply put, with inflation still high, the economy performing better than expected, this provides a hawkish surprise, i.e. boosting interest rate expectations for the UK. And so we're seeing this diverging UK-US interest rate outlook as a key catalyst behind the view that sterling could continue climbing from here. But we're also seeing that the pound is benefiting from three other key factors that I wanted to call out. The pound is still undervalued according to many models out there, including Oxford Economics BEER model. Secondly, the political instability and the fiscal and economic repercussions of such instability have diminished markedly in the UK over the past 6 months. And thirdly, the pound is a risk correlated currency, as we mentioned before, and it tends to track equities higher. And we've seen this 2-month correlation with the US benchmark equity index rise higher. So with that, as I mentioned, sterling dollar, the exchange rate hit a 1-year high in April and is trading in the top 10% of its year-to-date range, as you can see from the table. Now, against the euro, though, the volatility continues to be more subdued in this currency pair. Hence, it's at the bottom of this table, given its meager 1.6% trading range over the past 30 days. and it's only really trended in a 3% range year to date, as you can see, but slightly towards the top end of that range is where it currently lies. And I think a lot of the lack of realized and implied volatility that we're seeing in the sterling euro rate reflects the similarities witnessed in the UK and European economies at the moment, and the monetary policy outlook similarities as well. And for that reason, I think the pound and euro could continue to move in tandem with one another for the time being. Overall, though, the pound is competing with the Swiss franc for the title of the best performing major currency against the dollar this year, both with gains of about 3%. So overall, should be good news for UK importers selling pounds and buying foreign currency, particularly dollars. Not so good news for UK importers selling foreign currency and buying pounds back. However, if we zoom out, take a look at our value indicator analysis, we can see where sterling is currently positioned relative to its long-term averages against other major currencies. And this allows us to identify from a wider lens any FX purchasing opportunities and also any risks. So for example, if you look at sterling versus the Japanese yen, which I've called out here, this exchange rate is a whopping 13% higher than its 5-year average, and that's mainly because the Bank of Japan continues to keep interest rates in Japan at record lows. Sure, it's a traditional safe haven currency, but it hasn't benefited from that, from such a status over the last year or so, because investors are seeking higher yields elsewhere. If we look at the sterling dollar exchange rate, the very far right column shows the pair is 3.4% below its 5-year average rate, which is 129. So, companies selling dollars and buying pounds could still view the current rate as still attractive or to be capitalizing on. But on the flip side, if your company is selling pounds and buying dollars, the above 20% uplift from last year's lows that we witnessed, and the fact that the sterling dollar rate is currently 3.7% above its 1-year average of 120, could also be seen as an attractive position to be layering in hedges at these particular levels. We appreciate organizations will view certain exchange rates and hedging opportunities differently, which is why we're providing as much data-driven insight as possible to support those strategic conversations that you have with your account managers and your corporate hedging managers. Because when it comes to that currency planning, the aim is to help businesses identify and assess the drivers of the risks and opportunities, but also to understand their own risk appetite and tolerance and their goals and objectives, to then help them implement a currency risk mitigation strategy. Before I do move on to the forecast scenarios, just to delve a bit deeper into this currency risk mitigation strategy, I wanted to take your eyes over to the bottom right chart here, because this provides a little bit more evidence of the recent change in market sentiment towards the pound in particular. So this is data from the Commodity Futures Trading Commission, and it reveals that the speculators of currencies are now net buyers of the pound for the first time since February last year. And that means bets of sterling appreciating now outweigh bets of sterling depreciating in the future. And in fact, in April, speculators made the biggest addition to these positive bets on the pound in almost 2 years. And this doesn't mean to say that the pound will appreciate because of this, but what it does do is confirm that this positive shift in sentiment towards the pound based on some of those factors that I mentioned on the previous slide. So with that, I'll move on to the FX forecast scenarios. To reiterate, our stance at Convera is that we believe taking this scenario-based approach is more appropriate to safely navigate currency markets, as opposed to trying to outright predict exactly where exchange rates are going to end up over a certain time frame. And this is just because of the inherent inaccuracy of forecasters trying to do this. Instead, evaluating various scenarios that may occur in the future and understanding the possible exchange rate outcomes that occur with those scenarios unfolding should help businesses identify high-risk situations to avoid or to try and minimize potential losses, and also to identify opportunities that they can prepare to act upon. So the left-hand side of the chart, that's the historical exchange rate of sterling dollar in this case, and the right shows the different paths that the exchange rate could take in the future based on certain events and trends unfolding. And in partnership with Oxford Economics, a base case scenario and a high and low scenario are generated via an economic model using many variables like interest rates, growth and inflation differentials. And from that baseline, we calculate one standard deviation above and below to provide a more central scenario, which is the grey shaded area in the middle of that chart there, which via our calculations will cover 68.2% of the outcomes. So in layman's terms, there's a near 70% probability of the exchange rate falling within that grey shaded area. And this range has actually been revised higher slightly from last month's forecasts, and it's based on the developments both in the UK and the US in terms of the economic and monetary policy outlooks that we discussed earlier in the webinar. The top end of that central range, 130, and the bottom 120 by the end of this year, this is going to be heavily dependent on the Fed stance. That 130 is a key psychological level for the pound, and it hasn't captured that level for 268 days running now. That's the longest stint below this level ever recorded. But if the Fed does go ahead and cut interest rates, perhaps a surprise pause today, that would be a big surprise to the markets and could cause a big dollar sell-off. Markets are currently pricing in Fed cuts, but if we do see the Fed pause today and then start cutting, that could be the fuel that could be the fire to fuel the pound's run at that 130 level, that critical threshold. So that 120 mark, or the lower end of that range, that could come back into play though. The reason why that could come back into play is if the Fed pushes back against the current market pricing. We don't know what the Fed is going to do. The markets are pricing a 90% probability of a hike, but it's about the forward guidance really, where the focus lies. And if the Fed pushes back against those rate cuts that are currently priced in and keeps rates elevated through 2023 and into the early stages of 2024, defying those market expectations and increasing fears of a global economic downturn, this could be what drags that sterling dollar exchange rate down to the 120 again, perhaps even lower. Of course, there are more extreme scenarios we've got to acknowledge as well, such as the spillover effects from the banking sector turmoil, triggering turmoil across Europe and the UK, tighter credit conditions raising recession fears. Perhaps the Bank of England is even forced to cut interest rates this year, despite inflation remaining uncomfortably high. This kind of scenario, we could see sterling upside fade very quickly and the sterling dollar fall back into the teens. The upside scenario, though, the higher 130s, plausible if the UK economy continues to outperform. Upside macro surprises continue forcing the Bank of England to continue raising interest rates, giving the pound that yield advantage over the dollar, especially if the Fed does start to cut interest rates before year end. And also if volatility remains low as well, this should fuel a resurgence in risk appetite, which the pound is going to benefit from compared to the safe haven dollar. But the main takeaway, as ever, when it comes to this is that no one really knows what the future holds. The opposing forces are always in motion, and it's imperative to consider a range of scenarios to make sure that as a business, you're sufficiently positioned to take advantage of favorable moves in exchange rates, as well as being sufficiently positioned or protected rather in the event of adverse currency moves unfolding. Now moving on to the sterling euro forecast scenarios. As I mentioned at the start, this currency pair remains caught in a quite tight trading range, and the baseline forecast remains stable around 114 through this year and into the first half of next year, though its trajectory will largely be influenced again by the monetary policy divergences, which is going to again be data driven unless the banking turmoil becomes more systemic. In terms of the monetary policy outlook, the expectations for the European Central Bank are more hawkish than that of the Bank of England. And because of this, we suspect that the ECB announcement tomorrow may fall short of the market's hawkish pricing, and therefore we could see some downside risks to the euro in the short term. But next week, if the Bank of England falls short of market pricing as well, then this could send the pound lower. But if we look further out, the picture still remains pretty clouded because of this uncertainty around the economic and monetary outlook. It's true that underlying price pressures remain highly elevated from a historic standpoint in both the UK and the Eurozone. So it would justify both central banks, the ECB and Bank of England, to continue raising rates. providing no real advantage to either the pound or the euro in this scenario. But the lagged effects of the recent large rate hikes, the policy tightening, are likely to weigh on economic activity at some point and produce a sustained rise in spare capacity over the coming quarters. And in addition to this, headline and core inflation are set to fall sharply because of the energy effects fading that's anticipated from next month onwards. So together, the effects of rising slack and lower headline inflation are likely to create a mutually reinforcing cycle of falling inflation expectations, weaker pay growth, and a further decline in inflation. And this rings true for both the Eurozone and UK. So in terms of the currencies, it's a real tug of war that's going on, and it's likely to continue between the pound and the euro unless we see divergences in the economic data and monetary policy expectations. But what I will mention is that when we do see this currency pair break out from a particular trading range that it's stuck in, it's often triggered an acceleration in that particular direction. Hence why when we look at that wide range within the central scenario of 124 to the upside and 104 to the downside by year end, it does seem so large. So the upside scenario, we would probably need a 115 level to break. That's been a key barrier over the last few months or so. We need that to break, and that could be triggered by a more dovish ECB tomorrow versus a more hawkish Bank of England next week, which is why these central bank meetings over the next week or so are so critical for forward guidance when it comes to this particular currency pair. But a final remark is the importance of keeping track as well of euro US dollar, because this exchange rate is the most heavily traded currency pair in the world. So any major swings that we see in that currency pair can have a knock-on effect to other currency pairs like the sterling euro exchange rate. So for example, if we see euro dollar extend towards 115 or 120, this could limit any potential upside for sterling euro, potentially dragging it lower even. But as ever, there's plenty of dynamics to digest, but structuring for optionality, potentiality is what's critical, and that's what we advocate and believe is key for sound planning and preparedness. So that's the UK, the European currency outlook from me. I'll hand you over now to Joe for a North American point of view. Over to you, Joe.
All right, George, thank you. That's a terrific update on the economic situation across the pond, and very interesting how the pound has gone so low, or so long rather, keeping below 130 against the US dollar. Okay, so my job here is to talk about volatility analysis from the North America perspective. And as we can see here, volatility has been a bit of a mixed bag for the US dollar. We continue to see the Mexican peso rank at the top of the performance table with a vast 9% trading range, and that's just through the first 4 months of the year. Top line there, dollar Mexico, there you can see the 30-day range, both the high and the low, as well as year-to-date levels. And like I said, year-to-date so far, dollar Mexico has spanned a 9% trading range. So the dollar is at that bottom of the trading range. And it's a familiar theme of central bank policy divergence. Certainly the Fed has been really impressive in terms of how much it's raised interest rates over the past year. Mexico has really dwarfed what's happened out of the US. Mexican interest rates, you can see there at the top, it says the peso has been boosted by Mexico's record high interest rate of 11.25%. So yeah, quite an attractive yield. And amid a backdrop of fairly tranquil FX market volatility, that has been a real source of strength for the Mexican currency against the greenback. On the other hand, we've seen the dollar versus the yen. The dollar versus the yen exhibits remarkable strength, and that's also central bank rooted, given that Japan has maintained this hesitancy to join in the wave of global interest rate hikes. Japan, they do have a new governor in Kazuo Oida, but we're still seeing the same policies of the new governor that his predecessor had followed. And I think that just goes to show that Tokyo appears a bit skeptical in the outlook for global growth I think Japan is worried that we could see a US-led slowdown. And if that happens, maybe that would certainly be a bad thing for Japan's export-oriented economy. So consequently, Japan has signaled it's in no hurry to abandon these pro-growth policies, at least anytime soon. But as we've seen, central banks, they do have a penchant for surprise. So sooner or later, we're likely to see a move by Japan to raise interest rates because inflation there is running above the BOJ's target. So once we get some firm signals that Japan might be moving interest rates from these rock bottom levels just below zero higher, that could be a potential launching pad for the yen. So that's just a warning there, not to get too complacent with yen weakness, and perhaps sometime in the coming months, we could see a potential shift on the part of Japanese authorities. So we'll keep our eyes closely peeled on that. Now, more to the middle of the pack of currency market volatility, that's where you'll find dollar Canada. Dollar Canada is about halfway down there. You can see that dollar Canada really keeping to a more neutral ground for both the past month as well as year to date. And I think a lot of that has to do with central bank policy. We did see that Canada has continued to raise rates up until earlier this year. Canada did hit the pause button, and the Fed is perceived to be next in line to hit pause on rate hikes. And consequently, the similar path for monetary policy that has really kept volatility in check, you could say, for dollar Canada. Otherwise, the euro, we've talked about central bank policy divergence. Looks like the Fed, if it does raise rates today, we'll have to see if it does. There's been a little bit of skepticism I've seen in the media today about whether or not the Fed will go. But nonetheless, if the Fed raises rates today, that could very well mark the final rate hike of the Fed's aggressive tightening cycle. And that stands at odds with the view from Europe. As George and Steve have mentioned, it looks like we could see further rate hikes from Europe, and that has been broadly positive for the euro. So if you look at the range here, both over the past month as well as year to date, you can see that the euro sits comfortably to the upper echelons of those ranges, the position within the range, and that is boosted on expectations that while the ECB is likely to still raise rates, maybe later on this year, the Fed could be going in the opposite direction and cutting rates if we were to see a material slowdown in the US economy and even a potential recession. So those factors, policy divergence, that has been really powerful for the euro. Now, I want to take a higher level view on the next slide and talk about some of the value that we've seen. What kind of bang are we getting for the buck? Well, in terms of euro dollar, you can see that year to date, as well as the past year, the euro has bounced back. We did see the euro fall last year to 20-year lows against the greenback at one point inside of parity, inside the 1-to-1 mark. But we've seen a steady bounce back in the euro against the dollar. And but if you look over the longer term, say the 2-year horizon, 2 to 5 year horizon, you can see that the US dollar still maintains a fair amount of strength compared to levels over the past couple of years. The dollar is up, the US dollar is up about 2.5% against its European counterpart. So again, kind of a mixed bag in terms of the dollar value. But if you want to see where the dollar is getting the least bang for the buck, so to speak, that is once again against the Mexican peso. The peso has really outperformed, whether you're talking year to date, over the past year, or even out as much as 5 years. And again, a lot of that has to do with the fairly tranquil horizon, or the fairly tranquil scene for FX markets of late. Again, always subject to change, but that has been a real boost to the Mexican peso, because a lot of times what happens when currency market activity or currency market volatility comes, that tends to make a popular trade of the carry trade, where lower yielding currencies are used to fund bets on higher yielding currencies like the Mexican peso, and that's why we're seeing these broad-based gains over the short term, and even the medium to longer term for the peso. So that policy divergence, that is a key thing, and it's interesting in the case of Mexico because it seems like Mexico may also be near the finish line in terms of raising interest rates aggressively. So we'll have to see how that plays out going forward. Maybe we could start to see the peso start to surrender some of those gains if it looks like Mexico is near the end of the tightening cycle there. And now I want to get into some currency forecasts. On the next slide here, euro dollar. You can see on this chart here, if you look to the left, that's been the actual historical performance we've seen all the way out to late 2021. And towards the right side, the color shaded right side, you can see that is those are the potential paths that euro dollar could take. So right now, currently around 110. The markets, the baseline scenario is that we hold around these levels over the coming months, but we'll have to see what happens there, because like I said, all eyes are on central banks, especially the biggest ones like the Fed and the ECB, and they're the ones that are featured prominently this week. So upside scenario, what's the bull case for the euro? Well, if we see the euro, if we see the ECB continue to opt for these larger than usual interest rate hikes, that would tend to be really positive for the euro, because we haven't seen the ECB go any smaller than 50 basis points. And in the wake of news this week that we heard that Eurozone inflation inched higher, it's now at 7%, a 7% annual rate. Well, maybe that's an incentive for the ECB to maintain these big 50 basis point rate hikes. It remains to be seen if we'll get that tomorrow. But if we get a slowdown in the pace of rate hikes to say a 25 basis point move tomorrow, maybe that can check some of the recent strength we've seen in the euro. So as it stands right now, it looks like it's a close call whether or not we're going to get 25 basis points or 50 basis points in terms of a rate hike this week from the ECB. Another thing that could boost the euro is maybe the Fed today. There's certainly just a small chance of the Fed not moving. It's 10% or maybe 15% of the Fed not moving at all today. But if the Fed does signal that it looks like U.S. interest rates are at or near peak levels, well, maybe that could be another reason to push the dollar lower. Another reason for the market to push the dollar lower, because it would play up the interest rate differentials that have been so favorable for the euro so far this year. On the other hand, what's the bear case? What's the downside scenario for the euro? Well, if we start to see some of the resilience that we've seen for the Eurozone economy, if that shows signs of losing steam, that could cause the euro to drift lower, maybe get back below 110, maybe take aim at 108. We'll have to see how that plays out. And if the Fed maintains a high bar for cutting interest rates, well, that would kind of fly in the face of consensus bets out there now. The market is betting on the Fed cutting rates maybe a couple times by the end of the year. So if we get some firm pushback by the Fed that, hey, they're still really concerned about fighting inflation and they have no plans to lower interest rates, well, that could be a factor that could push the euro down lower. And lastly, what I want to talk about is the dollar-Canada pair, another popular one on this side of the pond. Dollar Canada, we can see that dollar Canada, if you look towards the left there, dollar Canada started the year around 135. It's moved, say, within 3 cents of that level, both to the upside and to the downside. So the year-to-date range so far, 132 to 138. What's the case for the US dollar to move towards 140 against Canada? Well, if we start to see all these rate hikes that we've seen from Canada, if they show signs of increasingly pumping the economic brakes north of the border, maybe that could be a situation that causes the Bank of Canada to pull forward expectations for rate cuts. And as we know, anytime there's a prospect of a rate cut, that tends to weigh on a currency as yield seekers look abroad where our currencies are more likely to rise. So that could be a negative factor for the Canadian dollar. And then the Fed, if we do get a rate hike from the Fed today, does the Fed maintain a tightening bias where they want to push back against market pricing of rate cuts? That could be another scenario that could prove positive for dollar Canada. On the flip side, however, the downside scenario for dollar Canada, if we see Canada's economy fare more resiliently than expected, that could certainly be positive for Canada. Maybe we could see dollar Canada potentially move down towards 130. One of the things that's been credited with supplying the Canadian economy with this resilience has been the job market. The job market in Canada, both in Canada and the U.S. That's going to be the focus of Friday. But unemployment in Canada is hovering around 5%, and that is a historically low level. So that bodes well for consumer spending, given that the jobless rate there remains historically low. And then, of course, one of the things that could weigh in the dollar, well, if the Fed feels compelled to indeed cut interest rates by the end of the year, like the market is generally pricing, again, that could be a situation that could push dollar Canada lower. So just some scenarios to consider there. And again, we do that scenario-based analysis rather than choosing levels, given that these factors are likely to be the leading ones to influence currency direction going forward. So now we can open it up for Q&A.
Thanks a lot, Joe. Some excellent insight there from a North American perspective, especially thinking about how the euro-dollar exchange rate in particular could play out, trends with that, and potential knock-on effects across the wider currency space, as I mentioned earlier, could have implications for the likes of sterling dollar and sterling euro as well. So let's see how the Fed plays out tonight, ECB tomorrow, Bank of England next week. Lots going on, lots to digest. Thanks everyone for sticking with us so far. That's the presentation section finished. We've got about just less than 10 minutes left dedicated to Q&A. So remember to use your control panel to submit any questions that you might have, and we'll try answering as many as possible. I do see one that's come through already. What does the current worries around the US debt ceiling mean for FX markets, and how do you see that playing out? Steve, I'll hand it over to you if you like.
Yeah, thanks, George. Again, that's one of the big risks that we have hanging over the market, and we were saying that something might come from left field to shock some of the volatility back into markets, and that's definitely one of the big risks. The most recent commentary we've had was from the US Treasury Secretary Janet Yellen, who said that on the current estimations that it would really start to become a concern. The US government will run out of money by around about the 1st of June. There's no exact time because there's a matching of the income that's coming in from tax receipts and the outgoings. They often try to move money from one account to another to try and extend the amount of time that they have. So there's no exact time, and in fact, you know, the debt ceiling itself ran out back in January or February. So there's no exact time, but it appears best guess at the moment is the 1st of June. And historically, yes, these issues do tend to get resolved at the 11th hour. There have been periods when it hasn't. You know, in the 1990s, in 2011, it got very close as well. And in those periods, we see the closer and closer that we get to that date, the more that markets start to see this as a concern, the more it starts to have an impact on financial markets. And equity markets, of course, very often can fall, but a lot of the focus is really in the US Treasury market, and particularly around that date where potentially the Treasuries, of course, are essentially a loan to the government, and around those dates where the bonds fall due after the date where the government will run out of money, particularly start to see a lot of volatility in those in those markets. Now, of course, bond markets and interest rate markets are critical for the FX markets, and so that's why you do sometimes see an impact on foreign exchange markets. Now, particularly what's interesting is that normally the US dollar will benefit from safe havens when there's a concern about financial markets, a concern about the global economic outlook. The US dollar will tend to outperform, but in this case, it often does not. If we look back to 2011, or last time that we saw this kind of crisis occur. In the month before it was resolved, and it was due in early August for the US government to run out of money, it was resolved just at the 11th hour. But in the month before that, we did see the US dollar really weaken, and that was really driven by the fact that concern about buying US government bonds, might not be able to be redeemed over the medium term. And so instead, markets really focused on other safe havens like the Japanese yen and the Swiss franc. So for now, markets believe that it will be resolved, but as we get closer and closer to that 1st of June date, it can start to impact on markets in uncertain ways. It can have a big impact on FX markets due to its relationship to interest rate markets. So it remains a major risk, I think, going in, and every day that's not resolved, it becomes more and more critical that can impact on foreign exchange and drive big moves in currency markets.
Awesome. Thanks a lot, Steve. Comprehensive overview there. Nice one. Next question come in. I'll take this one. How important do you view the de-dollarization story? Yeah, great question. One that's highly topical at the moment. You know, a number of stories in the press coming out recently claiming that the dollar is losing ground as a global currency. For those that don't know, just to clarify, de-dollarization refers to countries reducing their reliance on the US dollar as a reserve currency held by central banks to facilitate international transactions. And many of these stories we've been hearing link the supposed decline of the dollar to the geopolitical factors, such as the implementation of the sanctions by the US on other economies like Russia more recently. And there's certainly a growing concern, I suppose, that the dollar may become a permanent political tool, and countries don't want to be exposed to that. You know, it's true that smaller nations are experimenting with de-dollarization, and China and India are pushing to internationalize their currencies for trade. And Argentina recently said they're going to trade with China in yuan, ditching the dollar. Brazil and China have also agreed to trade in their own currencies as well. So there's lots of examples for sure. But the data is slightly less convincing. We've seen the IMF recently pointed out that the share of the dollar in world reserves has gradually edged down from the year 2000, from around 70% to just under 60%, 58% now. And it was last year where we saw the speed of this decline actually increase tenfold compared to the average pace over the last couple of decades. But some interesting counter arguments is that the fact that, and one of these is actually written by another analyst in the team, Guillaume, based in France. Basically, it's true that the level of dollar reserves has fell in 2022, and it is falling. But part of the reason for this, one or two reasons I'll provide. One being the valuation effects, because many dollar reserves are held in the form of US bonds, but the rise in US interest rates that we've seen have cut their value sharply. And secondly, FX intervention as well. You know, the dollar was so strong last year that it prompted a number of economies to liquidate reserves to support their own currencies, and we saw that in Japan and Russia, Hong Kong, India. So it's definitely more of a complex issue with a lot of finer details to consider. But what I will say is that the role of the dollar as an international currency, it won't be challenged anytime soon. I mean, even if dollar reserves are falling, the dollar accounts for 40% of the value of cross-border trade, and that's about the same as it was a decade ago. But bringing this back to how it might impact you and your business, though, you know, it might be worth asking your own suppliers who bill you in US dollars but are based elsewhere to invoice you in their local currency instead, just to see if there is a saving to be made, because many vendors often add a buffer to their bills in order to protect themselves against currency fluctuations. So it's certainly worth asking that question. I think we have one for you, Joe. You know, clearly this is a big week for markets and currencies. What do you see influencing markets over the coming weeks?
Yeah, that's a good one. Well, as important as this week has been in terms of central banks, I think the focus on central banks is only going to get larger as we move into June, because on a quarterly basis, we see some of the big central banks, the likes of the Fed and the ECB, what they do is provide not only a rate decision, but they provide fresh economic projections. So we'll get estimates on where the Fed sees the Fed funds rates, the Fed's main interest rate at the end of the year, where they see employment trending over the balance of the year, the economy, as well as inflation. Of course, inflation is the big thing. So we'll have to keep our eyes on the run up to the next central banks. And if I recall correctly, in mid-June, we're going to have back-to-back meetings of the Fed, the ECB, and the Bank of Japan. And that's one we'll have to keep a close eye on, the Bank of Japan, like we were talking about, to see if there's any forthcoming tweaks to monetary policy, given that so much of the world has embraced this higher rate policy, and Japan has maintained this hesitancy to follow suit. So central banks, watch those forecasts next time around. That's going to be really important. Plus, we'll find out whether or not the Fed indeed does hit that pause button on policy when we get the next rate decision.
Yeah, nice one, Joe. There is one final question. In the interest of time, I'll just wrap that up quickly and then close the call. It's just in relation to the banking crisis in the US, looking far from over, and how this affects the Fed decision tonight and going forward. I think we've covered it in a bit of detail, but of course, with the stress in the banking sector, it does increase the chances of the Fed pausing or pivoting this year. But of course, we'll find out more tonight. It's all about the Fed's guidance, and I'm sure there'll be quiz on the banking crisis. But yeah, the odds of a pause certainly rise with the stress continuing in the banking sector. So that's it. I'm going to respect the time. I know we've run slightly over, so apologies. But just make a final few remarks before ending today's session. Firstly, whatever email address you use to register for this webinar, you'll automatically receive the recording within 24 hours from the email address Currency Convo. And if you need the slides at all, then please do contact us via the details on the following page, or reach out to your account manager at Convera. And secondly, remember, this is a monthly webinar series. Therefore is going to be another one in early June. We hope that you can join us for that one to keep on top of this ever-changing environment. And lastly, please do take that exit survey, provide some feedback to us about this webinar today. How can we improve it? And any recommendations that you'd like to hear about particular topics for the future webinars. So thanks again to our speakers, Steve and Joe, and thank you to everyone for joining us today. Wishing you all the best and good luck. Cheers.
Thanks.
Thank you.